You are welcome to yet another session. Today we are going to be talking about farm accounts. Farm accounts are statements of money paid out or received for goods and services used in the farming business. Money is received due to sales of farm produce or loans from outside sources, while money is paid out for purchases of farm produce or settlement of debts. Basically, in any business you have, the general accounting concept is the same. It's just for you to understand the peculiarities of businesses. For you, that's how you'll be able to know how to tackle the peculiarities. And this farming business is used to address every aspect of accounting that one might encounter in a farm, ranch, or related business. The intent is to not only explain accounting concept but also to provide examples and show how an accounting system can be constructed and operated in the farming business. One of the things you should look forward to or you should have in your mind is that generally the way and manner in which the uh, farm business is being run in especially a country like ours is that they are not always that much structured. So you should expect single entry or incomplete records from this farm. So based on that, you have to be able to bring information by using control accounts and incomplete records methodology. The type of records that are needed. There are different types of records related to farm businesses, of which the following and among they are among the following are among the required documents or records. Daily farm records. There are records on all important daily activities and events that happen on the farm. These could include the selling, the purchasing, the usage of input and all that, and even the weather condition and how the daily activities are happening. So the other thing is the record of farm implements and equipment. We also have record of agricultural inputs, record of uh, livestock products. Then we have record of animal feeds, production records, record for farm use and farm expenditure records. Basically, we explained in our last session that accounting information are broadly classified into four uh, groups. And we talked about income, expenditure, asset and liability. So if you look at all these records that are being mentioned here, they basically fall into one of these categories, like the farm implements, equipment, agricultural inputs, livestock and livestock products. All these, they in a way fall in part of the assets. While some are part of fixed asset, others are current asset because they are things that get used up or they can sell them off and in return for cash. So the production records, record for farm use and farm expenditure records are basically the records that you require to prepare your income statement to be able to know how much you have spent into production, how much you have gotten from the sales and the expenditures that have gone in and all that. So you'll be able to know to calculate trading profit, then your actual net profit at the end of the day. So why is farm record is important? Uh, Generally, when you have lenders or agencies that are funding the farm or um, some sort of investors in the business, they need to have adequate records to be able to know the the way and manner the business of the family business is operating and if they are doing well and if the money is actually used for what it is being given for. So they need to have these records. And again, for better farm planning and forecasting, For you to be able to plan and forecast, you need adequate records so that you'll be able to tell, okay, this is how much I spend on this is how much I spend on that, this is how much I can gain from this is how much I can gain from that, and all that. So based on that, you'll be able to plan and forecast. Then again, prediction of rainfall and weather. See, since you have daily records, you record how rainfall, how the weather condition. You'll be able to understand the pattern of weather condition to be able to ascertain when to plant and when you are expecting to harvest and all that, and when some maybe livestock need to be vaccinated or what have you, or to be given some drugs and taken for some checks and all that. So these are the importance of farm record. Then another thing is to track income and expenditure. We have mentioned one of the main uh, aim of any business is income, to make income or to make profit or to maximize profit. So in order to do that, you have to be able to track your income and expenses so that you don't spend more than what you are earning, and consequently making a loss. So you have to be able to track income and track expenditure. These are part of the importance of farming records. So in the overall, what you are aiming at is to have a better management of the farm. So management includes planning, forecasting, prediction, tracking, and all that. So that you'll be able to adequately manage the farm and safeguard the assets of the farm. Um, the farm account has some characteristics that you need to understand, and this stated as thus: we have special departmental account for different activities. All what we are going to be doing in the farming account is not just knowledge that just dropped from heavens. It has to be, we are going to use knowledge from other aspects of accounting that we already know. So we look at anything that we are faced with here, we look at what is relevant from other things we have learned from accounting that we can apply here. So for instance, we have different aspects of the farm, like the dairy crops, the fruit and livestock rearing, and the rest of them. So based on this, for you to be able to report adequately, you have to segregate these departments into by preparing account for each of them. Then later on, you can now do the aggregation of the figures. So you have to, if you have different aspects or departments, you prepare accounts for each of those ones. Then you can now aggregate the result at the end of the day. So if you have department like dairy where you have dairy products, crops, fruits, and livestock rearing, you have to now subdivide it into those activities, and you come up with the individual trading profit and loss account. Then you can now consolidate it at the end of the day to be able to know the profitability or the profits, to ascertain the profit of the farm itself in general. So another thing you should note is that the system of transfers is the same thing as every other commercial business, which is, for instance, when you have debit wages account and credit rent received account for laborers that live in the farm. What we are saying is that the normal treatment for the income, expenditures, assets, and liabilities is the same for this kind of business. You just have to identify what makes up the income and expenses and assets and liabilities of the farm. That's just what may make it different. That's the peculiar aspect, but the treatment of those things are the same. The system of rotation of crops resulting in a number of fields lying fallow. What they're talking about here is that you may not have throughout the year the same type of production for the whole piece of land or the field that the farm possesses, because sometimes some land are made to lie fallow while they regain their vitality, so that there will be high yield in the future. So it's not every time that the farm is operating at its full capacity. Sometimes it has to leave some, uh, especially for crop production and anything that has to do with planting. So sometimes you will have to leave um, the land to lie fallow so that it will be able to increase its productivity. Then high organized farms keep statement data and registers, while small farms does not accept attempt to keep any data. Generally, if you have a small farm or people that are just operating subsistence farming or some middle sized farms, they don't normally pay too much attention to keeping records, which makes the work of an accountant even more tedious, because you will have to just they only prepare maybe have a single entry, or they have what they call incomplete records. So you have to be able to generate some other records by using your knowledge of control accounts and single entry and incomplete record methodology. So, but for highly organized farms, they probably will have a professional accountant or a well-trained accountant that will be able to keep all the statement data and registers and all what have you. All the records will be adequately kept, and the preparing account for that kind of business will not be that much of a difficulty. Now, occasionally, heavy expenditures incurred on seeds and fertilizer may be spread over a period, while um, equipment purchase will also be capitalized. What this point is speaking about is uh, generally in accounting, we have been talking about expenditure, which expenses to be capitalized and which not to be capitalized, which will be expensed. So they are saying here, if you have some heavy expenditure on seeds and fertilizer, it can actually be spread over some period and can be capitalized alongside the property, plant, and equipment, or the fixed assets that are capitalized. So that is what the point is talking about. Now, farm experts do valuation of livestock and manorial rights. Now, at the end of the period, you don't expect the livestock to still be the same value with when at the beginning of the year, because you feed them, they grow, and they should be worth more at this point in time at the end of the period. So there's need for valuation of the livestock and the manorial rights, which are the property of the farm. So it's needed to be valued to know the actual value at the end of the period, because when you plant, even aside livestock, when you plant on a land, the value of the plantation in month one is different from the value in let's say month six, because by that time it must have grown bigger and all that. So that is what the point is speaking to. Then we have compensation for loss in case of destruction of animals and crops as a result of diseases and pest control. And this leads to the fact that there's need for adequate insurance covers. For example, loss of cattle, drew strain, and livestock. Um, so there are accounting requirements for any business that, as we have discussed and as we are still discussing now, that you need to, for any business, there's need for ascertaining the profits, and there's need for knowing the net worth of the business. So for you to calculate a profit of a trading business, which farming fall into or fall under, you have to calculate the trade, to know the trading profit by calculating it through the trading account, then the profit and loss account to actually know the ultimate the surplus at the end of the period, or loss, as the case may be. Then you need to prepare your balance sheets. And for you to prepare these two statements for a farm that has incomplete records, or they have single entry records, there's need for you to calculate the sales, for you to calculate the purchases, and for you to know the opening capital, and for you to make some adjustment to expenses and income if need be. What we're talking about here is about um, for the sales and purchases. This is what you can use to actually calculate your trading profits, to say, okay, this is the total amount of what I've sold, and this is the cost of what I've sold, and this is the amount of goods that was purchased, this is the opening stock, and all that. You'll be able to now know your gross profits from there in your trading account. Then this will now be taken to the profit and loss account, where you now deduct other incomes and other expenses that are incurred during the period. and that to know the actual expenses and income incurred during the period, you have to sometimes do some adjustments to the expense and income figures depending on which one falls due during that period. Then another thing is for you to calculate the opening capital for the business, because since their records are not complete or they are single entry transactions, so you may not be able to adequately capture what the owners may not be able to actually adequately capture what the opening capital they have invested into the business is. So you have to calculate that on their behalf. How do you calculate sales? To calculate the total sales that is going to your trading account is going to be the cash sales and the credit sales added together. And the cash sales, you can just see that you can get that from your cash book or your bank statement. While the credit sales, you need to calculate that based on the ledgers of your debtors, what they have paid, the amount you sold on credit, and what they have paid back, and those things that have reduced their total indebtedness. So in that sense, we will need something that they call the total creditors control account or sales control account, where is the calculation of purchases, which is just the opposite somehow on the right side. You can see there. Now you have your total purchases. This balance brought down here is talking about the balance brought down of debtors. And know that debtors are current assets which have debit balance, and you can see it on the debit side of this account. It is brought down, meaning it's coming from last year to this year or last period to this period. Now, anything that will reduce the balance of these debtors, that will reduce what they are owing us, is what is on the credit side, and anything that will increase it is on the debit side. So if they pay us on
bank
cash
and
or
cash,
they
bills
pay to our
payable,
bank,
return
then it
outward, cash
reduces the amount. If you have some
scam
bills
received,
receivable,
contract set
maybe
off,
there are
just the
some
same
bills,
explanation
some
as
of
in
the
the
bills has been
um,
accelerated from being
the
debt to
sales
bill receivable, then you have it
calculation.
there.
So now at the end
Then
of the
if there
period,
is
you have
any
balance
part
carried
of the
down,
stock
balance
that was
brought down.
sold to
Balance
them
brought
that were
down
returned,
being the
maybe for
creditors at
some
the end of the period,
damages
and
or
the
for some
balance
other
figure for
reasons,
this account
then you
is
have it
credit
here.
sales,
Then we
which is going
have
to be
cash
added
discount.
to the
Maybe we
credit
allow them some
purchases and the
discount on
total
the amount taken
to
to.
the
Then we have
um,
it. Now the next thing is to calculate
the
uh, calculation of the opening capital. In calculating the opening capital, what you need to do is to add all the opening assets minus all the opening liabilities. You get your capital straight up. So that is how you calculate the opening capital. And some of the things that may be included in the opening uh, uh, assets are land and building, plant and machinery, furniture and fittings, equipment, tractors and motor vehicles, inventory, accounts receivable, bills receivable, prepaid expenses, accrued income, cash and bank balances, and other things that may come in. Then under opening liabilities are loans, account payables, bank overdraft, bills payable, accrued expenses, prepaid income. So when you add them all, you have this, then you deduct it from the total assets, you have your capital down there. So it's just as simple as it is. Now the next item is the adjustment of expenses. Expenses, when you can see on this side you have prepayment brought down and accrual brought down. Prepayments are those expenses that you paid for in advance before you actually enjoy the services, and they normally are asset to you. While the accrual are expenses that you ought to have paid, but you have not paid for them, but you have already enjoyed it. So that should be a liability. So anything that will increase the total expenses will be added to the right side, while anything that will reduce will be on the credit side. Now, uh, if you have cash bank, you paid, it will be debited. Payment during the period will be debited. Then you have prepayment carried down and accrual carried down. Just as you have brought down of prepayment at the beginning of the period, the carry down will be on the opposite side, and the carry down of the accrual will be on the credit side as well. So the brought down at the end of the period of our accruals will be on the credit side, and the prepayment will be on the debit side, meaning that the prepayment at the end of the period still is an asset, while the accrual is a liability. Um, for the adjustment of income, accrual brought down because it's an income that is supposed to have received and you have not received it. It's accrued income, so it becomes an asset to you, current asset. Why the prepayment, if you paid an income, if you have paid an income earlier than when you're supposed to earn it, then it becomes a liability to you. In that same sense, any income that you receive, because income are always credited, so you have it on the anything that will increase the income will be on the credit side. So you have cash and bank received during the year. Then on the other side, you have that's all the items that you can have. Then you have the balance carried down for the prepayment and balance brought down for the prepayment. At the end of the year, you have the balance brought down for the accruals and balance brought down for the prepayment. So accruals of income is an asset, and prepayment of an income is a liability, while an expense is an asset and accrual of an expense is a liability.